We'll begin with a statement followed by questions.
Well, good morning. Bonjour tout le monde. It's a pleasure for Senior Deputy Governor Wilkins and me to be with you here today to talk about the December issue of the bank's Financial System Review, which we published this morning. I'd like to take a moment to give you some context for the report. The FSR highlights key financial vulnerabilities and some potential triggers that could turn those vulnerabilities into risks to the stability of Canada's financial system. The FSR is an essential complement to our monetary policy report. Together, these two reports give the basis for a complete discussion of monetary policy within our risk management framework. À notre dernière date d'annonce sur les taux d'intérêt, nous avons décidé de laisser le taux directeur inchangé, étant donné que l'économie progressait de façon raisonnablement conforme à notre projection d'octobre. Nous avons aussi indiqué que les risques liés à la stabilité financière évoluaient comme prévu. La livraison de la RSF publiée aujourd'hui présente l'analyse sur laquelle repose cette évaluation. Our interest in financial stability risk has grown since the financial crisis for two distinct reasons. First, the global regulatory architecture has been strengthened to prevent future crises, and how the system adapts to those changes needs to be well understood. Second, persistently very low interest rates in response to the crisis are fueling new financial vulnerabilities that bear constant monitoring. So let me start with the financial stability implications of new regulations for financial intermediaries. The global financial system is clearly safer than it was before the crisis. Now, this is important, for it means that vulnerabilities that appear worrisome today need to be assessed against a more resilient system. At the same time, our financial system is adapting to these new regulations, and we must be alert for any new vulnerabilities that might emerge as a result. As one example, some observers contend that new capital and liquidity rules have led to reduced market making in secondary fixed income markets and may also be responsible for occasional liquidity shortfalls and market gaps. Well, we analyze this vulnerability in greater depth in today's FSR. In fact, it's proving very difficult to assess the liquidity issue empirically. Most of the available data suggests that government bond liquidity may have improved in recent years, but these data tell only part of the story. The bank recently established the Canadian Fixed Income Forum to enable a continuing dialogue, and we've modified our own operations to help alleviate some of these issues. The Governing Council believes it's important to continue studying the matter, not just as it pertains to government bonds, but also to other asset classes. Given the new regulatory architecture, we may not know just how resilient market liquidity is until there's a true stress event. J'aimerais maintenant aborder les vulnérabilités créées par la persistance des taux d'intérêt très bas au Canada. L'après-crise a tout naturellement favorisé l'endettement des ménages, ainsi qu'une hausse de l'activité dans le secteur du logement. On observe d'autres éléments de comportement financier à risque, mais ces deux vulnérabilités retiennent notre attention depuis un certain temps déjà et ont continué de gagner en importance depuis l'apparition de la dernière RSF. In terms of household debt, income growth hasn't kept pace with increases in borrowing, since mortgage growth continues to rise. More borrowing was expected, given the reductions in our policy interest rate earlier this year. It's important to remember, though, that while rate reductions have increased vulnerabilities at the margin, they've also mitigated the risk to the financial system by helping to offset the decline in incomes and employment tied to the drop in commodity prices. Our analysis shows that there's been an increase in the number of highly indebted households in Canada, by which I mean those whose debts are more than 350% of their annual gross income. Not only are there more of these highly indebted households, they also carry a growing share of total household debt. These people are more likely to live in British Columbia, Alberta, or Ontario, where house price gains have been the largest. The Governing Council's reading of the situation is that these vulnerabilities are quite highly concentrated. About 720,000 households fall into this vulnerable category. Pour ce qui est du marché du logement, nous continuons d'observer une évolution des marchés régionaux suivant des trajectoires différentes, comme nous l'avons déjà souligné. L'activité dans les régions productrices d'énergie, l'Alberta, le Saskatchewan et Terre-Neuve et Labrador, a passablement diminué, comme escompté à la suite du recul des cours de pétrole. Les marchés du logement de Toronto et de Vancouver ont repris de la vigueur grâce à une croissance plus forte de l'emploi et des migrations interprovinciales et internationales. The Governing Council's base case scenario continues to be a constructive one. Housing activity should stabilize in line with economic growth as the driver of growth in the economy switches from household spending to non-resource exports. However, recent momentum in prices in Toronto and Vancouver may increase the likelihood of a correction in house prices, which could affect vulnerable households. Unsurprisingly, house prices are correcting in oil-producing regions. As in the past, we've illustrated how certain triggers could turn these vulnerabilities into full-blown risks to the Canadian financial system. Risks assessed in this FSR are, first, a severe recession that would reduce households' ability to service their mortgages and cause a broad correction in house prices. Second, an unexpectedly sharp rise in global risk premiums that could spill over to the cost of domestic financing. Third, economic or financial stress emanating from China and other emerging markets. And fourth, more downside risk in resource pricing. Cette liste n'est pas exhaustive. Ces risques servent à illustrer les conséquences possibles des vulnérabilités que nous avons relevées. Parmi les autres événements déclencheurs, citons par exemple un incident de crédit de grande ampleur dans le secteur mondial des ressources, ou un incident touchant le crédit souverain. The Governing Council acknowledges that certain vulnerabilities are still edging higher, but the overall level of risk that they pose to the Canadian financial system has remained roughly unchanged since our June report. In this regard, recent changes by Canadian authorities to the rules for mortgage financing will help to mitigate these risks as we move into 2016. Finally, I'd note that the FSR features reports that take a close look at aspects of the Canadian and global financial systems. With this issue, there's a report that analyzes the microdata related to household debt, as well as a review of mortgage securitization in Canada. And these are very important and useful reports, and I hope you'll take time to read them. And with that, Carolyn and I will be happy to respond to your questions.
We'll start with Kim McCrell, Wall Street Journal.
Hi, Governor, thanks for taking these questions. I'd like to ask if you could speak a little bit further about what you referenced in the report on the firming of the economy in the second half of the year. Can you give a bit of context for what that means, firming compared with the contraction that we saw in the first half of the year, and whether that firming, to what extent you're able at this point to take into account some of the reports that we've seen for October, such as trade and manufacturing, and when you talk about the economy firming?
Okay, well, as we said in 2 weeks ago on our interest rate announcement, to that point, the data had fallen into line pretty well with our October projection. That, of course, had already seen the first half contraction, which was fairly focused sectorally. We were watching for the positives that we'd identified a year ago to become the dominant numbers, and that appears to have happened in the second half of the year. Certainly we were expecting positive growth in the second half of the year. Therefore, since the negatives are still in there, the positives are beginning to outweigh. We also mentioned that although Q3 was quite good, it was not necessarily the new trend line, that in fact we expected Q4 to be a little softer than Q3. I won't offer a full running commentary on the data, but there have been, as you noted, some data points that have come out on the soft side since then. There's also been some on the plus side. So I would say that in general, things were still more or less in line. But we're in the midst of our update for the January NPR. Believe it or not, that's how the sort of way these things go. The forecast exercise is underway now, taking account of all those things. But your soft points were GDP at factor cost, or the GDP monthly series, heavily affected by fire up in northern Alberta. The manufacturing report affected by that, by the shutdown of the Irving oil refinery in St. John. So there's some special factors at work in some of these that we should not lose sight of. And the positives were mostly from the consumer, either car sales or housing developments have been very strong still. So that's a mix of data, like there always is, and the data never go in a straight line. So I stick with what we said a couple weeks ago, which is so far things have been more or less in line with that dynamic that we predicted would happen.
Thank you. And just as a sort of unrelated follow-up, in terms of housing, you spoke about the FSRs from December, and then I think in June it repeated the notion that Canadian housing overall is overvalued between 10 and 30%, and that's, I believe, not in this report. And I just wondered if you could speak about why you made that decision.
Well, we had a research report that tried to look its best to look at this issue, and that was when we referenced it in our FSR, a couple of FSRs in a row. And at the time, we also pointed out that there are a number of reasons why it doesn't tell the whole story. A model like that can only take into account certain things. It's a global model. It's intended to draw from housing corrections across many countries, so we capture all the common factors. But it can't actually capture things like, is there a constraint on developing housing? For example, in the Vancouver area, there's only so much space, similar to like Hong Kong or those kinds of markets. And there can be not just physical limitations, but also, if you like, permitting and all those other kinds of limitations on growth. And so those things aren't captured. And secondly, that we have such a variety of experiences going on within Canada. A single model can't really explain all that divergence. And so given that divergence is growing as we sit here, which I'd say is related to the terms of trade shock that's affecting Canada, then as that unfolds, a single model for that has less and less relevance to the kind of question you're asking. And so we just didn't think it didn't really have a place in the story we're telling at this moment, but it remains important research that we're continuing to explore. It did at the time suggest there was a degree of overvaluation, a wide range of possible numbers, but that it had been overvalued in that sense for many years. So it's not something that suddenly happened either. So all that is enough qualification. That's why it's just not it's not headline material in my opinion. Yeah.
Andy Blatchford, Canadian Press.
Yes, Governor. Excuse me. Thank you for taking our questions. I was wondering, of these 720,000 vulnerable households you're talking about, I was wondering how many are under the age of 45? What concerns do you have that so many young people are more at risk, and what can be done to sort of ease these risks for younger people?
Well, to start, what we're trying to analyze here is the risks to the financial system, not the risk to individuals. The things we pick up on are symptoms that we try to gather in and figure out if those pose threats to the system. So what we've suggested all along is that there were emerging pockets of concern, which are in those. These are, relatively small, say 8%, something along those lines of households are in this high debt area, and tend to be younger, as you suggest, tend to be in certain geographic areas where housing is very expensive. So that's kind of the combination that gives you these numbers. And so the government's changes announced on Friday are kind of directed at that pocket of risk. And so the idea is to make sure that the system has more resilience. It isn't to stop people from making up their own decisions in this space. Carolyn, would you like to add something?
I would just add, if you wanted to look for the actual number, there's some interesting graphs in the FSR. Like chart 8 basically shows a distribution. There's a special report in the back that would have more specific numbers if you wanted to look at that. But as the governor said, they tend to be younger people. So by that we mean under the age of 45. You can tell that we're over the age of 45, yes, if that's what we say.
Younger than us.
Younger than us. And also they tend to have lower income.
Yeah.
So that represents in our minds a vulnerability.
Also, Governor, I was wondering, looking back at the year, you've had it has been a remarkable year. There have been 2 rate decreases, ongoing oil slump, weak growth, little fiscal stimulus. I was just wondering, how would you assess 2015, and what was it like for you to oversee it as governor, and what do you hope for 2016?
How much time do we have again? In a nutshell, I mean, it was a challenging year, of course, because we started off with a shock of great size, and analyzing that, and not only was it a big shock, but as I said to you before, it is the most complex type of shock that an economist can face. Even though it's the only type that's really visible, you can see it happening. The implications go through so many channels, as we laid out in the January NPR. So it's been in that sense, it's been a challenge. At the same time, there's an element of, I'm very happy with the way our own staff managed to stick handle through that, to figure out what would happen. That it would be, a big negative, a big decline in growth, in the first half. And then by then the positives that they identified would start to show up. So that seems to be coming true, which is very good. But in the end, it still leaves us with another year in the, if you like, the serial disappointment series that we thought that we'd be farther ahead by now. So it's definitely delayed that progress that we've been watching for. So under the surface, we see all the elements happening, so that's satisfying. But it's taking longer because of this shock that we're going through. Well, looking ahead, I'm looking ahead to all the way to January, when we'll give you a better look ahead. But as we've said, we do think that that the positives will be dominant in 2016. In our October outlook, we weren't predicting really strong growth, just acceptable, let's say, acceptable growth, somewhat faster than potential growth, so that we would be closing up some of our excess capacity gap. That's what we said in October, and for now we have to wait and see what the staff say about how everything's affecting that view now. Thanks.
All right, Anna Golubova, WPP Online.
Hello, Governor. Hello, Senior Deputy Governor. My question is about household loans. In the FSR, there's a mention that there's currently no evidence of significant increase in the loan delinquency rates. And I was wondering if you could talk more about the research that goes into it. How do you oversee it, and how up to date that research is?
Okay. Can we take that?
Sure. Those are actually numbers from the financial institutions, and so it's really just a reporting. And in fact, when you look at those numbers, what you do see is some variation across the country, not surprisingly, depending on the regions. So the regions that are more affected by the reduction in commodity prices have a little bit more of a uptick pattern in the delinquency rates, but nothing very strong. I mean, that kind of indicator tends to be a lagging indicator. So, because if you can imagine, if people lose their jobs and they start to get underwater, they may have some cash or some savings to tide them by, for a little while, and so they do tend to be a lagging indicator. I would say, though, that the strong underwriting standards of the Canadian financial institutions, as well as what we see so far on the real side of the economy, so the labor market, for example, points to a vulnerability, but then a very low probability of a risk actually materializing.
Thank you.
All right, Greg Quinn, Bloomberg.
There were rule changes on Friday, and getting up to a half dozen rounds of changes. Even still, there are several economists who say there's probably going to be more to come next year because the measures on Friday targeted 1% of the market. Are there a range of good options left to tighten the housing market, and what might they be if the government or you would want to consider them?
Well, there are quite a number of possible ways in which one could adjust those rules, but I mean, I think those details are best left to others. I think that for us, the macro situation is one in which in recent years, the changes that have been made in the past had been quite timely and had gone a long ways to helping us maintain a level of comfort, even though vulnerabilities continue to grow throughout this period. I guess the implication is that those vulnerabilities could have grown a lot more without those changes. And similarly, our analysis over the last year has been that the housing market is responding more or less as we would expect it to. When we cut rates twice this year, it was to create some stimulus that would offset a negative shock. And so it would have been unfortunate if we hadn't seen some response from consumers, either housing or cars or other spending. And we are seeing it. So that shows you that policy still can buffer those kinds of shocks. That's a degree of acceptance of an increase in vulnerability along the way. And yet in a macro sense, it's hard to really get down and to figure out if it's truly making it more vulnerable, or is it previously unindebted consumers who are taking on new debt, making the aggregate numbers go up, even though individually no one's more vulnerable than before. So hence all the work we've put into the microdata and an understanding of things, and that gets you down to the idea that there are pockets where the vulnerabilities are concentrated. And so that's the good thing is that the system is such that there are things you can do which address the pockets as opposed to doing something blunt that might affect everything. And so that's to be welcomed. So that's a very targeted measure. So knowing that means that we continue to monitor as this plays out. We have every reason to think that vulnerabilities will continue to progress, but obviously, given the actions, they'll progress at a lesser rate. So there's a further mitigant in the system, and we'll all watch that with interest as we go forward. And as we said, that by next year, we're hoping that the constructive evolution we talked about will be more firmly in place. And that would see the housing market cruising into a slower growth path, which is more in line with income. So sort of a stabilization in how much of the economy is being driven by housing. And that the growth driver will then switch to non-resource exports as opposed to housing. Housing has been a very important, and consumer spending, let's say, housing and cars and other things like that have been the main driver of growth practically since the crisis. And that's one of the reasons why the Canadian economy has had a better performance than others.
One other element I notice is a few years ago, many people had said that Toronto and Vancouver may be dangerous markets, but if they crashed, housing is local. It seems in today's report there's more commentary around the idea that maybe there'd be a national implication if one city had a crash. I mean, should people be worried in Moose Jaw and Halifax that condos in Toronto crashing there could ripple into their neighborhoods?
Well, I mean, I think not. I mean, to me, that the question really is how much of the activity we see in housing is a macro phenomenon versus a local phenomenon. And to the extent that it is a macro phenomenon, then it's shared across the entire space, then that would be a measure of the risk that you're laying out. We see very important fundamentals moving that suggest that those markets should be strong. So good employment growth, immigration in both of the major centers, supporting that housing market. And so it's always hard to sort out all of those things. So in the end, all we're trying to do is identify what risks might be evolving, and we can't put concrete measures around that decomposition that you described. But basically, I think of it as primarily a local phenomenon. Would you agree?
Yeah, I would. If you look at, I mean, it's hard to disentangle the structural and the cyclical things. It always is. Just one of the things you can look at, if you think about it saying being a land restriction issue, whether it's geographical or regulatory, you just look at the difference in the house price growth for singles and multiples. And so I didn't look at the data for today in that detail, but if you look at October data, you see in the greater Vancouver area that singles are the year-over-year price growth is like 21%. It's really big. It's about twice for what it is for apartments, which are mostly condos. And in Toronto, it's a similar thing. It's about 12%. And again, that's about twice. So you can see those factors at work. Now, you know, if there's a big macro shock, it'll affect everyone. So as the governor said, and that's part of the risk that we look at. And I think the other thing to keep in mind, it is a local thing, but the greater Vancouver area and GTA are 1/3 of the housing stock and about 1/3 of the mortgage debt. So it's not insignificant either. And as we see, we don't see any evidence of excessive supply responses. We see the economy unfolding largely as we thought, and so we think the probability of a problem is occurring is low.
Right, next question, Raoul Vedianeth, Epoch Times.
Yes, thanks, Governor and Senior Deputy Governor. I just wanted to ask about, with the Fed expected to raise rates tomorrow, could potentially drag Canadian bond yields higher, make for slightly tighter financial conditions here in Canada, but you've also mentioned in the last announcement about divergent monetary policies, and that seems to say that that's going to be the case. I just wanted to get your thoughts about the rate hike and perhaps even what is implied by the dot plot, what that could mean for Canadian financial conditions, in the next little while, and how you see that playing out, given that it's a phenomenon that hasn't taken place for nearly a decade.
Yes. And I don't presume that it will happen tomorrow either. Well, we'll have to wait and make sure that something happens, but before we start analyzing it. But I think that the best place to start is the context in which it would be delivered, which is a solid U.S. economy, one that matters very much to our own outlook. So that's an ingredient that's very important to bear in mind. That's the thing where we see the exports and non-resource categories growing, especially the exchange rate sensitive ones. Well, that's primarily a U.S. destined exporting. So that's an important start, number one. So in that context, and this is one of the risks that we analyze here, is what happens to the global risk premium, i.e. the shape of the term structure to the world, and therefore to us, as this unfolds. And right now, we could just look at past experience and expect that we would, as you suggest, see probably some movement in our bond markets, our longer-term interest rates, in sympathy with whatever happens to the U.S. yield curve. So if that happens, then we'll have to take those movements into account as we redo our forecasts, which is something we'll be doing over the next few weeks and delivering in January. And we'll be able then to figure out what implication it has for our outlook, along with everything else that has to go in. And until then, I think it's best if I just hold back the rest of the answer.
Question in the back. Could you introduce yourself?
Au sujet des 720 000 ménages canadiens dont le ratio de la dette au revenu dépasse 350 %, vous dites dans une note de bas de page que si les prix des logements baissent de 10 %, 156 000 vont se retrouver avec un logement dont la valeur sera négative, c'est-à-dire que l'hypothèque sera plus grande que la valeur. Vous avez dit dans le passé que, possiblement au Canada, le marché du logement pouvait faire l'objet d'une baisse de 10 à 30 %. Dans votre document, vous nous parlez de 10 %. Avez-vous les chiffres du nombre de Canadiens dont la valeur de l'habitation serait négative si la baisse des prix des logements est de 20 % et ensuite de 30 %?
Merci pour la question. On pourrait bien le calculer, je ne l'ai pas devant moi. Je pense que c'est très important de faire ce genre d'analyse parce que justement, un des problèmes qui pourrait survenir, ce sont les gens qui ont une valeur nette négative. Alors, évidemment, on s'en occupe. Mais il faut aussi dire que juste parce que j'ai une maison, puis la valeur de la maison est moins élevée que mon hypothèque, ça ne veut pas dire que je vais faire faillite. Ça dépend tout de la circonstance. Donc, il faut avoir ces chiffres-là, mais il faut quand même, par la suite, faire une analyse de la situation de ces gens-là. Est-ce qu'ils ont un emploi? Est-ce qu'ils ont des épargnes à part qu'ils pourraient payer? Et pour avoir une façon de payer, de continuer à payer. Donc, on pourrait calculer les chiffres, mais ce ne serait pas suffisant vraiment d'analyser l'ampleur du risque.
Sous-question, aux États-Unis, une des caractéristiques de la crise des subprimes, c'était précisément que des centaines de milliers de gens se sont retrouvés avec une hypothèque dont la valeur excédait la valeur marchande de leur habitation. Est-ce qu'il y a au Canada, dans des poches peut-être, mais est-ce qu'il y a un risque de cette nature-là? Dans la mesure où aux États-Unis, jusqu'à ce que la crise des subprimes éclate, presque tout le monde niait qu'il y avait un problème. Est-ce qu'on a un problème au Canada?
Je crois qu'on n'a pas un problème généralisé du tout. Il faut quand même regarder des petites parties du pays où il y a des problèmes. Mais ce que je peux dire, il y a quelques différences entre le Canada et les États-Unis. Une des différences, c'est que si on regarde dans l'ensemble du pays, il y a plus d'équité dans les maisons qu'il y avait aux États-Unis. Okay, ça, c'est la première chose. Il y a aussi 30 % de personnes au Canada qui n'ont aucune dette du tout. Okay? Et la troisième chose, je dirais que c'est sûr que les faillites aux États-Unis étaient un problème, mais le problème était amplifié de beaucoup par la structure des marchés financiers où il y avait ce qu'on appelle la titrisation, où on faisait un actif qu'on changeait, on le construisait de façon tellement compliquée que les risques ont été répandus, mais que ça créait des canaux de transmission de choc et de stress qui étaient une surprise. Alors, aujourd'hui, au Canada, on n'a pas ce genre de titrisation complexe.
Leah, sorry, cut off. Leah Schneider, Reuters.
You mentioned in the FSR that the risk to the financial system from commodity prices, about where they are now or a little lower, the severity of that risk is relatively low. But is there a different level of severity or a higher one to the broader economy that might have to be addressed through monetary policy?
Well, yes, if you look at what we've been through this year, we had a very big commodity price shock to deal with, and it was sufficiently large that it caused, 2 quarters of negative growth, a contraction in the economy. We could see that other parts of the economy were still growing and enough to dominate in the second half. Basically, if you had a shock on the commodity side that was large enough and long enough, those negatives could outweigh for a longer time. And then you almost get to risk number one, right, where you have, in fact, then for whatever reason, you cause a recession, which is sufficiently widespread that the risk becomes just the same as risk number one. We're distinguishing the two because obviously there's more. There are more differences than between the two for that reason. But you're on the right track.
As we sit here today with oil prices where they're at, what difference is there between where we were last December with oil prices falling, leading into an interest rate cut, besides the interest rate cut that happened?
Well, there's a pretty big difference in our expectations, because at the time a year ago, we were just starting to see the oil shock for what it was. If you were just a couple months before a year ago, there was almost no sign of it. It was just a little soft, but looked like it would be temporary. And so we were expecting continued acceleration of growth both in the U.S. and in Canada moving into 2015. And it was for that reason that the revision in January felt so big, because you were not just having a shock down, but from what you expected before was a pretty significant revision in view. And it clearly threw us outside that zone we talk about, the zone of balance, where policy reaction was called for. And the situation we're in now is we have most of that shock on board, and the effects of our interest rate cuts continue to work their way through the system. So we have, unfolding in front of us some of the offsets still to come, plus the positives from the oil price decline as well. So that's a substantially different mix in macro terms.
Richard Madden, CTV.
Governor, I'm just picking up on Leah's question a moment ago about the slump in commodity prices, and we've focused a lot on households, on the impact on households. But just if prices continue to slump, are financial institutions, brokerages, lending houses, are they at risk if they are exposed to commodity prices and oil? Can you see a scenario where they could be at risk?
Well, everybody's exposed to commodity prices to some degree. One mitigant that we have in this case is that a lot of the lending in the space happens through stock markets. So it's there the risk is spread through capital markets as opposed to falling on a financial institution. But of course, financial institutions are exposed not just directly, but indirectly, because it could be regional and they could have a lot of mortgages, let's say, in that space. So let's just say that as this thing unfolds, we have to continue to monitor it. But as our judgment right now is that what we've seen is, I can't speak to individual banks, but the system as a whole appears to be quite resilient to it.
And you touched on the Fed decision. Can you outline a scenario with changes south of the border, how that might impact Canada's economy going forward, specifically the loonie?
Well, as we indicated in our press release 2 weeks ago, this is a situation globally where divergence is something we should be expecting. The terms of trade for Canada, as you know, is falling significantly through this, at the same time as the U.S. terms of trade is rising. And so this is exactly the situation the situation in which we are glad that we have a flexible exchange rate regime, because that is an important stress reliever. It reacts to the terms of trade and spreads that adjustment and actually speeds it up. So the history is littered with sad stories where economies tried to hold their exchange rate unchanged when faced with a major terms of trade shock, and paid a much bigger and longer price for it. The underlying adjustments are unavoidable. You can't just somehow offset them with policy. And so we will see, this adjustment being worked through in the resource side of the economy for several years. And we'll see things like, softer house pricing in regions that are affected by it, and stronger house prices in regions that are growing faster, those kinds of divergences. And we're going to see policy divergences between countries that have these two experiences. And so in that situation, we just want people to understand that, usually you think of the Canadian economy following the U.S. economy fairly closely. This will be one of those places where it really doesn't. It will follow. Parts of it are following. But as a macro statement, there will be a divergence there. We're already seeing it. And so you should expect a divergence in policy, too. And I mean, for now, that's about all we can say as we continue to watch it unfold and continue to incorporate the new data as they show up.
Gordon Isfeld, Financial Post.
Governor, Deputy Governor. I wanted to touch upon the decision on, or the announcement on Friday by the Finance Minister on the on mortgage changes, rule changes. Just want to know how much, given the interaction between both bodies, how much warning or notice were you given, and how much consultation were you given before the Friday announcement?
So we have a multi-agency structure for issues like this. We call it SAC, which sounds fancy, but it's just a special advisory committee. It's chaired by the Deputy Minister of Finance, and we attend, and OSFI attends, and FCAC attends, and who have I just missed? Anyway, that's and so then it's in that context in which we discuss CDIC, of course. Sorry, and CDIC attends. So we're all. That's the context in which we discuss these issues. It's where we present our FSR and our latest thinking on those things. And so that's the channel by which we offer our advice on those things. To the extent that there were conversations between myself and the minister, those conversations remain in confidence, period.
The reason I'm asking, because of the timing, obviously, with this release of your document today, these changes don't come into effect till February. You'll have an NPR before that time as well. Is there going to be a lot of kind of, I don't know, the second guessing of what's going to happen in the market, because we're not going to know, going a quarter past January when we don't even know how the February changes to mortgage rules are going to impact?
Well, you know, that's always true. Whenever there's a policy change, you never really, it's not a matter of arithmetic or mechanics to figure out how it's going to impact things. I just want to repeat that we were, through the process I've described, we were fully consulted on this, and that we had some, you know, with the contents of the announcement, we were given a heads up. But it was not surprising in the sense that we have been talking about it. So I think that, you know, given the situation we face, it's a constructive change, and something, as I said earlier, we have to watch its effects, and it'll be commingled with the effects of other things that are still ongoing, so it's not obvious how it will all turn out at this stage. Yeah. In the meantime, we'll have an NPR in January, and that'll be about monetary policy as opposed to about financial stability.
How are we doing for time?
We're long, but
good. All right.
I have another question, just very quickly, if that's okay.
Okay. Last question.
Last question.
I just wanted to get your sense. Last week, when the finance minister announced he's tightening mortgage rules, that seemed to come out of nowhere. We saw a StatsCan yesterday that confirmed household indebtedness continues to rise. More concerns about housing markets, particularly in Toronto and Vancouver. That's also outlined in your report today. I mean, there might be a lot of homeowners in this country who are worried about the housing market. And you talk about risk today. I mean, what would be your message to them about the state of the housing market in this country?
Well, okay, well, I could go on for some time, but I would say that as I discussed in my speech a couple of speeches ago, the first and most important place where this issue comes up is when the borrower and the lender are talking about it. So that's the first line of defense. So it's up to the borrower to understand what their decision means for them, and it's up to the lender to help them get all that information and make a good decision. The context is there. We have very strong underwriting in our system, great rules for all that. So I'm confident that that's been maintained. We've had a question before about comparing Canada to the U.S. From pre-crisis. There is no comparison. There's just no similarities to what we saw back then. And so that's because we have a much stronger underwriting culture. and because of the changes that were made along the way, that the space in which they operate was tightened up in various ways progressively through this. So, so I think that's the most important thing. People need to understand that, you know, it's very unlikely that interest rates would stay this low forever for the life of an entire mortgage. I mean, that's very unlikely. I think everybody understands that. And that's part of the conversation that happens, as I understand it, when people are getting a mortgage. So let's just test your finances if it was, you know, a little bit higher, this much higher, those kinds of things.
I guess what I'm trying to get at, is your concern about Canada's housing market, has that increased, has that elevated?
The vulnerabilities we've identified continue to edge higher, but we have strong faith in the fundamentals, which is that the economy is back from that temporary contraction that we saw. It's growing again, and our expectation is that it will continue to gather momentum through 2016 and into 2017. And in that case, then, if you like, the fundamentals are coming up to meet that housing. And so that's where the strength comes from. It comes from jobs and incomes, new jobs, new incomes, stronger incomes, more economic growth. So for us, that is, the actions we've taken are meant to reduce the odds of a trigger that caused those kinds of problems that we're highlighting. And I think from what we see so far, it's working. So we're quite confident about it.
All right, thanks for joining us here today.
Thank you very much.